The Invisible Titan, a comprehensive guide to RTX Corporation. Ticker RTX. The aerospace and defense behemoth, formerly known as Raytheon Technologies, is operating at a scale and complexity that few companies in history have reached. Following its massive Q4 2025 earnings beat on January 27, 2026, the stock has surged, recently trading near $202.62. The narrative for 2026 has shifted from recovery to execution, as RTX works to convert a staggering $268 billion backlog into free cash flow. For an investor today, RTX represents a diversified bet on the global aviation recovery and the urgent modernization of national defense. This guide explores the company's three business segments, the status of the geared turbofan engine recovery, and the landmark defense agreements signed just last month. 1. The business model, a triad of innovation. RTX is uniquely positioned because it is roughly equally exposed to both the commercial aerospace and defense markets. This balanced model provides a natural hedge. When commercial travel slows down, defense typically steps in to provide stable cash flow. 1. Collins Aerospace, approximately $30 billion segment. Collins is the world's largest aerospace supplier. It produces everything from flight deck avionics and oxygen systems to cabin interiors and landing gear. In 2026, Collins is the primary beneficiary of the aftermarket boom. As airlines keep older planes flying longer to meet surging demand, they must buy high-margin spare parts from Collins. 2. Pratt Whitney, approximately $33 billion segment. This is the engine powerhouse. Pratt & Whitney produces the F-135 engine for the F-35 fighter jet and the GTF, or Geared Turbofan, for commercial airliners. In early 2026, Pratt is the focal point of the company's turnaround story as it moves through the final stages of a major engine inspection program. 3. Raytheon, approximately $26 billion segment. The defense-focused arm. Raytheon is the world leader in missile defense, Patriot, precision munitions, Tomahawk, and advanced sensors. In February 2026, this segment secured 5 landmark agreements with the U.S. government to dramatically scale up the production of critical missiles to 2 to 4 times their previous rates. 2. The 2026 catalyst, the new munitions supercycle. The biggest news for RTX in early 2026 is the Framework for the Future agreements signed on February 4, 2026. Accelerating the arsenal of freedom. Raytheon entered into multi-year agreements with the U.S. Department of War to significantly increase production capacity for 5 key weapon systems. Tomahawk cruise missiles. Production is scaling to over 1,000 per year. AMRAAM air-to-air missiles, aiming for at least 1,900 per year. SM-6 interceptors, increasing to more than 500 per year. These aren't just one-time orders, they are 7-year frameworks that provide RTX with long-term revenue visibility. This structural shift toward higher munitions output is a primary reason the stock has rallied over 60% in the last 12 months. 3. The GTF recovery, turning the corner. For much of 2024 and 2025, the powder metal issue in Pratt & Whitney's GTF engines was a significant drag on the stock. In 2026, this issue is finally being de-risked. Aircraft on ground declining. In the recent earnings call, CEO Chris Calio confirmed that the number of grounded planes peaked in late 2025 and is expected to continue declining through 2026. Cash flow tailwinds. The compensation payments to airlines, or the cash drain, are moderating. In 2025, the outflow was $1 billion. For 2026, it is projected to drop to $700 million. The GTF advantage. Later in 2026, Pratt & Whitney is expected to enter into service the GTF Advantage engine, which management describes as a step change in durability. 4. Financial performance, the backlog to cash machine. RTX's financial profile in early 2026 is characterized by massive scale and improving efficiency. Key financial benchmarks. 2026 sales guidance, projected at $92 billion to $93 billion, representing 5 to 6% organic growth. Adjusted EPS, management expects between $6.60 and $6.80 for the full year. Free cash flow, FCF, this is the most important metric for RTX. The company projects $8.25 billion to $8.75 billion in free cash flow for 2026, a significant jump from 2024 levels. Shareholder returns. On February 6, 2026, the board declared a quarterly dividend of 68 cents per share. RTX has paid a dividend every year since 1936, and with a payout ratio of roughly 53%, the dividend is considered highly secure. 5. Critical risks. What could derail the rally? Despite the bullish sentiment, an investment in RTX carries 3 specific execution risks in 2026. Fixed-price contract pressure. Like its peer, Lockheed Martin, Raytheon has several high-tech programs that are fixed price. If inflation or supply chain disruptions drive up the cost of labor or titanium in 2026, RTX must absorb those costs, which could lead to margin compression. The Airbus standoff. In early 2026, reports emerged that RTX is carefully balancing engine deliveries between new Airbus planes and the spare engine pool. If Airbus cannot get enough engines to meet its own 2026 delivery goals, it could lead to friction and potential performance penalties for RTX. The debt load. RTX holds significant debt. Net debt is projected to rise to $33.7 billion in 2026. While its cash flow easily covers the interest, a higher-for-longer interest rate environment makes refinancing that debt more expensive than it was 5 years ago. Regulatory scrutiny. As the world's largest aerospace and defense company, RTX is a constant target for antitrust and defense budget scrutiny. Any major shift in U.S. foreign policy or a defense audit could impact the valuation multiple. 6. Strategy. How to position RTX. As of early March 2026, RTX is no longer undervalued. It is a quality at a fair price investment. The dividend plus strategy. The core holding. Due to its 1.4% yield and stable long-term contracts, RTX is a favorite for retirement portfolios. It offers more defensive characteristics than a pure tech stock, since its revenue is literally signed into law via the National Defense Authorization Act. The wait for the $195 floor. The stock recently rallied from $112 to $202. Technical analysts see a strong support level at $194 to $195. For a new investor, nibbling, buying 1/3 now and waiting for a broader market pullback to finish the position is a prudent way to manage the risk of a short-term correction. Valuation check. Currently, RTX trades at a forward PE ratio of approximately 30 times to 31 times. This is at the high end of its historical range, reflecting the market's extreme confidence in the $268 billion backlog. Conclusion: the pulse of global sovereignty. RTX Corporation (RTX) in 2026 is the quintessential essential industrial. It is the company that makes modern flight safe and modern borders secure. By successfully navigating the GTF engine crisis and securing long-term supercycle munitions contracts, management has built a fortress of revenue that stretches into the 2030s. The verdict is, if you are looking for an investment that combines commercial aerospace growth with defense stability, and you can handle the complexity of an engine turnaround, RTX is a premier choice. You aren't just buying a stock, you are buying a 100-year-old engineering firm that is currently building the HCAM, or Hypersonic Attack Cruise Missile of the future.